pitch sounds effortless. Sell an electric car, skip the gas station, print money. Then look at the actual numbers. By late 2024, Tesla had driven its manufacturing cost per vehicle down to the lowest point in company history, around $35,100 a car, and its automotive gross margin was still stuck below 18%. This is a company moving over 1.5 million vehicles a year, and its profit per car sits closer to a grocery chain's margin than a tech company's. Here is what this actually costs. Nobody enters this industry by renting a warehouse. You need a Gigafactory, and the first one Tesla ever built carried a budget of up to $5 billion before it produced a single cell. The Nevada site alone had cleared $1 billion in construction permits inside 2 years, and kept rising past $1.3 billion the year after that. The Texas plant was filed at $1.06 billion just to cover its initial buildings, and Musk later put the full, long-run price tag above $10 billion once vehicle assembly and cell production were both operating. Stack on top of that the tooling, the stamping presses, the paint shop, the casting equipment for the structural battery pack, and the multi-year contracts required to lock in cell supply, and one competitive plant costs well over $5 billion before a single vehicle leaves the lot. Then add what almost never makes it into anyone's spreadsheet: federal safety certification, state-level emissions, and franchise law paperwork, the crash test cycle every vehicle must clear before it's street legal, and environmental permitting that alone can run into the tens of millions before construction even starts. Add the raw material contracts for lithium, nickel, and cobalt, negotiated years in advance, often before the factory that will use them is finished. That's the entry fee, before a single customer has clicked order, and before the company has any evidence the market will actually absorb the volume it just committed billions of dollars to build. Then comes the money that never lets up. Raw materials, steel, aluminum, copper, glass, sit at the top of the list, because a car is, in physical terms, a few thousand pounds of commodities purchased at prices Tesla doesn't set. Battery cells come right after, and even with years of falling lithium costs, they remain the single most expensive line item in the bill of materials. Labor across stamping, body, paint, and final assembly is a fixed cost per shift, whether the line is running flat out or half empty. Freight and duties move every finished vehicle from plant to port to delivery lot, and tariffs on imported components add a charge to every single unit that crosses a border. Warranty reserves get set aside before any car actually fails, because the accounting has to plan for the ones that will. Facility overhead, the engineering payroll behind autopilot and full self-driving, and R&D spread across the whole fleet finish the stack. Added up, Tesla's own reported cost of automotive sales revenue reached $56.3 billion in 2025, plus another $11.6 billion in cost of services and other revenue. That's the entire bill. Before profit enters the conversation, before counting interest on the debt that financed the factories making any of this volume possible, and before the cost of the service centers, tow trucks, and mobile technicians required to keep every one of those vehicles running once it's already sold. So how does the money come back? At the actual going rate, not the optimistic one. Tesla's average selling price has been falling for years, and the trigger is well documented. A wave of aggressive price cuts starting in January 2023, with the base Model Y dropping 20%, and the base Model 3 dropping 11% inside the first few months, across 5 separate cuts between January and April alone. A lower price times higher volume can still push revenue up on paper. A lower price against the same cost base pushes margin down underneath it. Tesla's total automotive gross margin ran 19.4% in 2023, dropped to 18.4% in 2024, and slipped again to 17.8% in 2025. Pull out everything that isn't a straight vehicle sale: energy storage, software, service revenue, and the core business of building and selling a car is running near its thinnest margin since before the pandemic. Net margin, shockingly thin. The single input this business least controls is lithium, and the last 4 years are the sharpest supply chain lesson the auto sector has seen since the oil shocks of the 1970s. Battery-grade lithium carbonate was trading around $7,000 a ton in early 2021. By December 2022, it had rocketed past $81,000 a ton, a move of more than 1,000%, fueled by automakers scrambling to lock in long-term supply during the EV boom. Then China trimmed its EV subsidies, demand growth cooled, and every mine that got greenlit during the spike came online, right as the market stopped needing the extra volume. By the close of 2024, lithium carbonate had fallen almost 90% off its high. Any manufacturer that signed supply deals near the 2022 peak spent 2 years paying multiples of spot price for material a rival could buy for a fraction of the cost at the exact same time. That's not a footnote in a cost model. That's the whole margin, erased, for reasons that have nothing to do with how efficiently the plant is run, how well-trained the workforce is, or how disciplined the company's engineering decisions were that quarter. Fisker Inc. wasn't a garage operation with a dream and a deck. It was built by Henrik Fisker, the designer behind the BMW Z8 and the Aston Martin DB9, and at its peak, the company carried a valuation of $2.9 billion. Its Ocean SUV pulled in real reservations, real investor enthusiasm, and genuinely favorable design reviews. But according to Fisker's own bankruptcy filings, the company was already sliding into potential financial distress as early as August 2023, under a year after the Ocean started shipping. Total production landed around 10,000 vehicles, far short of its targets, and quality issues followed a large share of them out the door, including a recall over warning lights that displayed incorrectly. By April 2024, Fisker pulled its full-year financial guidance entirely, a clear sign leadership no longer trusted its own forecast. A rescue deal with a bigger automaker, reportedly Nissan, collapsed. On June 17, 2024, Fisker filed for Chapter 11, listing $500 million to $1 billion in assets, against as much as $500 million in liabilities. The plan was confirmed that October. Shareholders got nothing, and the company is still under SEC investigation. This wasn't a shortage of design talent. Critics liked the car. It was an inability to survive a cash crunch in an industry where fixed costs don't pause just because a quarter goes badly. This wasn't bad management. This was the structure of the business itself, a structure that punishes any company without deep enough reserves to absorb a slow 18 months. There's a line buried in Tesla's income statement that most people tracking the stock barely glance at. For more than a decade, Tesla has been selling regulatory credits to other automakers that can't hit government emissions targets on their own. That revenue climbed from just $169 million in 2015 to a peak of $2.76 billion in 2024. And in that single year, it accounted for nearly 40% of Tesla's entire net income attributable to shareholders. Taken quarter by quarter, it looks simple. Tesla delivers a car, books a sale, reports a profit. Clean. But once you know a substantial slice of that profit came from a compliance market Tesla has zero authority over, the picture shifts. In 2025, as emissions rules changed, that same credit revenue fell 28%, down to $1.9 billion, with the credit value per vehicle sliding to roughly $1,218, down from nearly $4,000 a car a decade earlier, when Tesla sold far fewer vehicles. A revenue stream that size vanishing inside one policy cycle isn't a footnote sitting on top of a business already under 18% margin. It's the gap between a strong quarter and a weak one, and it never gets flagged separately on the headline number investors actually see. It just quietly makes the whole company look more profitable than the core act of building and selling cars actually is. In December 2023, Tesla issued the biggest recall in its history. More than 2 million vehicles across the United States, covering nearly every Model S, X, 3, and Y on the road. After a 2-year National Highway Traffic Safety Administration investigation, concluded that Autopilot's driver monitoring system wasn't strong enough to prevent misuse. NHTSA had opened at least 35 special crash investigations tied to the system since 2016, linked to at least 17 confirmed deaths. The fix was a free over-the-air software patch, cheap by manufacturing standards. But the liability behind it isn't cheap at all. One safety finding at fleet scale forces a company to account for every vehicle it has ever built, all at once, with federal regulators, plaintiffs' lawyers, and the press all watching in real time. Weeks later, a second recall hit another 120,000 vehicles for a door-locking defect. This is the kind of cost that can end a business in a single event, not because the fix is expensive, but because the reputational and legal exposure attached to it has no upper limit set in advance. Scale is a double-edged sword here, which is what makes this business so unusual. What improves with scale? Fixed manufacturing costs spread thinner across more units, so the Gigafactory and the stamping lines cost roughly the same whether the plant makes 500,000 cars or 2 million. Battery buying leverage improves, supplier terms improve, and the fact that Tesla's cost per vehicle hit an all-time low of about $35,100 in late 2024 is proof this side of scale works exactly as expected. What gets worse with scale? Regulatory exposure grows right along with the fleet, so a defect once contained to 50,000 vehicles now touches more than 2 million at once. Pricing power erodes as Ford, GM, BYD, and a fleet of Chinese manufacturers copy the same playbook at lower prices and thinner margins of their own. A single quarter of price cuts now moves tens of billions in revenue, because the fleet has grown large enough that 1 point of gross margin is worth close to $1 billion a year. Past a certain size, this stops being a car company managing production costs and becomes a systemic operation managing regulatory, geopolitical, and commodity risks simultaneously, at a scale most industries never approach. A supplier hiccup that would barely register at 50,000 units a year can strand tens of thousands of finished vehicles at 2 million units, all waiting on the same missing part, and every day that part is unavailable, the fixed costs of the plant keep accumulating regardless. Roughly half the automotive startups that went public during the last decade's SPAC boom have since gone bankrupt, been delisted, or sold for parts. Fisker, Lordstown Motors, and Electric Last Mile included. The root cause was almost never engineering. It was running out of cash before production volume caught up with fixed costs. The ones that survive share a set of unglamorous, repeatable habits. They lock in commodity contracts in tranches rather than all at once, so no single price spike wrecks a full year. They maintain at least one revenue stream outside the vehicle itself: software, energy storage, regulatory credits, because vehicle margin alone can't absorb a bad quarter. They hold off on new capacity until existing lines are running near full, instead of expanding ahead of confirmed demand. They cut prices defensively, ahead of a competitor forcing the issue, rather than waiting and cutting on worse terms. They keep enough cash on hand to ride out one full commodity or demand cycle without raising new financing, since the roughly 2-year gap between a lithium spike and its collapse is exactly the window that wipes out undercapitalized rivals. Note: list format above is for the script document only. Deliver as flowing narration on camera, not as an on-screen bulleted list. None of it is exciting. None of it makes headlines. It's the difference between still building cars in 5 years and becoming someone else's case study in a video exactly like this one. Like a simple machine. It isn't. It's the output of a $5 billion factory, a commodity market capable of a 1,000% swing in 2 years, a regulatory credit system that can shrink 28% in a single policy cycle, and a recall exposure that grows with every vehicle ever sold. What's actually being sold here isn't the car. It's the ability to survive all 4 of those risks at once, quarter after quarter, on a margin most industries would consider too thin to bother with. In a business where one bad supply contract or one delayed recall can wipe out years of cost discipline in a single quarter. Subscribe if you want the real numbers behind the next company everyone assumes is simple.